Hello and welcome to Options in Plain English Advanced Edition. Today we're going to talk about dividends and dividend risk for options. What's a dividend? A dividend is a payout going from a company or from an ETF to shareholders or unit holders, and it comes out of the company's or the fund's coffers, so from their money. So this is something that the unit holders or shareholders are going to receive. So if we start talking about a stock, for example, that's trading at a certain price prior to the dividend, and then they announce and they are going to issue a dividend. This is, in this case, we're going to talk about cash payouts. So this dividend is going to go to the shareholders that own the shares prior to the ex-dividend date. Now, for dividends, there's a bunch of dates, but the one that's the most important to us and the only one that we're going to care about is the ex-dividend date. There is also an announcement date. There is also a record date and the payable date. Those dates we don't really care about. The one that we care about is the ex-dividend date, which is the date when the stock starts trading without the dividend. Ex-dividend means without the dividend in Latin. So ex-dividend date is a very important date for us. Now, if we talk about option traders, they don't get anything related to the dividend. Call holders, put holders, call sellers, put sellers, they don't participate in this dividend payout. However, the stock price is affected by the dividend payout. How is it affected? Usually the stock price is pushed down by the amount of the dividend by the market, because otherwise there could be a situation where some traders might try to arbitrage the dividend just by buying the stock prior to the ex-dividend date and then getting the dividend and selling it out the day after. So to avoid this, the market automatically adjusts the stock price. So dividend coming out means stock price going down by the amount of the dividend. And then it starts fluctuating in normal trading move and normal trading price moves. So if we think about this and the stock price is going to go down because of the dividend, then it would be easy to figure out that calls are going to be going down and puts are going to be going up. Why? Because the price, the fact that there's a dividend coming up, which is known by the market, is going to push the price down. So calls are hoping for market appreciation, for stock price appreciation, and puts are hoping for stock market or stock prices declining. Because of this, calls go down, puts go up. Now, how does it affect the different calls and puts? Well, if we think about whether it would be advantageous for an option holder to exercise their options prior to expiration based on the dividend, if you think about the puts, well, a put is going to allow you to turn your stock into cash, because if you exercise it, you're exercising your option to sell. So since there's a dividend coming up, now you used to have shares and you don't have shares anymore. Well, then of course a put would not be the ideal vehicle to try to take advantage of the fact that there's a dividend coming up. So neither out of the money nor in the money puts are going to be involved in exercising in early exercising of options. So in the case of calls, if you think about it, we start analyzing the out of the money calls, well, there is no situation where it would be advantageous to early exercise the out of the money calls. Why? Because the you would be better served just by going to the market and buying at the price that's trading at the market, right? So because if they're out of the money, of course, the strike price is higher than the current price. So we've already talked about puts. We're not gonna be exercising early. We already talked about out of the money calls. Now let's talk about in the money calls. What will happen if you have an in the money call? Well, some of those calls that are in the money, actually all of them, if there's time to expiration, are going to have an intrinsic and an extrinsic component. And if we were to convert your calls into stock, then you would receive a dividend. If you stick with calls, then what's going to happen is the price is going to go down, so the calls are going to go down, but you're not going to receive a dividend. So let's analyze the case of in the money calls. Now, before we start, as you know, this is a graph of extrinsic value versus moneyness. So basically where the price is. We see that at the money options, both calls and puts hold the most extrinsic value. As you start going in the money or out of the money on both sides, the extrinsic value is going to start going down. So if we're sufficiently in the money or sufficiently deep in the money, then we're going to get to a point where, since the in the money calls are going to start going down because of the price decline based on the dividend, we take a look at the dividend that's coming up, and we have an in the money call. Okay. So we have an intrinsic portion and extrinsic portion. Now, if we stick with the calls, we're not going to get the dividend. But if we exercise the calls and convert them to stock, then you're going to get stock receiving the dividend, but you're going to give up the extrinsic portion of the call. This is the reason why the options are almost never exercised early. However, what happens in the case where you're sufficiently in the money so that the extrinsic portion of it is small enough that is smaller than the dividend? Then you're going to be giving up this portion and you're going to get the dividend. So you're going to be in a better place just by doing this. Okay? So if you have this situation, what you should do is exercise those in the money calls, convert them to stock, give up the extrinsic portion of it, get the dividend, and now you're going to get the stock plus the dividend. And you're going to be in a better position. Now, let's analyze this whole situation here. When you had a dividend, you had an intrinsic and extrinsic portion of an in the money call. You go sufficiently in the money, so deeper in the money. The intrinsic portion is there, and then a smaller extrinsic portion, which is smaller than the dividend. You exercise, you get the stock, and you get the dividend. So basically what you did was, you used to have a call, you turn it into stock by exercising. But there's one thing, so this is going to be better for you, of course, because you're giving up a smaller value than the dividend that you're getting. But there's one thing to notice here. Before, when you used to have a long call, this is for, I'm talking about the call holder. We're going to talk about the call seller, so the one who's short the call in a little bit. But right now we're talking about the one who's holding the call. If you're long the call and you turn it into a long stock, then one of the things that you notice here is it's a very similar graph, but now you are exposed on the downside. So before, you used to be flat on this area because the most you could lose is the amount that you paid for when you bought the call. When you have stock, and it depending on where you are, you can go up a lot, which is the same as a call, but on the downside, you can go down a lot. So you can start losing a lot of money. So this is an exposure that you probably don't want. And with options, you have the flexibility to hedge this off. So basically to protect yourself so that you can replicate what you used to have before, because that's the position you like. You don't want to change your position. What you want to do is you want to capture the dividend, be in a better position, but still be exposed to the same risk that you had before. So if you think about put call parity, and we're going to talk about this subject in a little bit later in another lesson, but basically what it says is that the underlying or being long stock is equal to being long a call and short a put, which means that a call is going to be equal to being long the stock, so long the underlying, and then long a put. So you went from the call to a long stock, so long underlying. We need to add the put, and then we're going to replicate the exact same situation that we had before. So now we have the first conclusion that we can deduce from this exercise. The amount of the dividend that's coming up needs to be greater than the cost of the put used to hedge the underlying, resulting from the exercise. So basically, when you have a call and you turn it into stock, you need to add the put, and then you have the same position. Now, if the put that you need to add costs you less than the dividend that you're going to get, then you're in a better situation because you're going to pay for the put less, and then you're going to get the dividend, which is more. So you're going to get a difference in your favor, and you're going to have the exact same position that you had before. So let's summarize what we already did. So we used to have a long call that's in the money, and we exercise it, and we turn it into a long stock plus a long put. Now we buy a put that costs less than the dividend that you're going to get after you turn your call into stock. Why are we doing this? The reason why we're doing this is we're trying to analyze and determine whether it's advantageous for a call holder, remember the one who bought the call, to exercise early. Remember, we said in the past that there is almost no situation where it pays to exercise early if you're the long holder. So basically the holder of the option, either call or put. Well, this is the one situation where it pays to exercise early. And it pays, and it's not only a way to get extra profit. What you don't want is you don't want to lose money, and you at least don't want to miss out on the dividend that the stock is paying. So because when you're long a call, you're betting on the company going up and going higher, the price going higher. But if it starts paying dividends, then that money goes nowhere because option holders don't get any dividend. But the stock price is going to be affected. So what you want to do is you want to avoid this effect. So it's not so much to make huge profits, although it could be used that way, but it's for the most part used to avoid the loss that would come with the issuance of a dividend. Okay, so you used to have an in-the-money long call, you turn it into stock and the long put, and if the price of the put is higher than the dividend, then you're in a better position. You get the dividend and you have the exact same position that you had before, and you didn't lose any money. You actually made some money. Okay. After this, what you can do is you can sell the stock and sell the put, and then buy back your call, whatever it is that you want to do. You're not gonna lose any money by doing this, by switching from an underlying put back to a call. So that what you do afterwards, it depends. It's entirely up to you, because this underlying is going to hold some capital. It's going to hold more capital because the price of the underlying, of course, is higher than the price of the call. So that one's going to be up to you. Now, remember, this we're analyzing from the call holder. Now, if you are on the other side, if you're the call seller, and in the call that you're analyzing is sufficiently deep in the money such that the put has a value that is less than the corresponding put, the same strike put has a value that is less than the dividend coming up, then you know that pretty much for sure you're going to be exercised. So you're going to be assigned a short position. So if you, at that point, remember, if you're a call seller, then, and you're assigned, there's two options. You either have the stock. So if you're assigned on a short call, the stock gets called away from you. So you were going to receive a dividend. Now you're not going to receive it. So you lose that way if you're assigned. And if you don't have the stock, if you were only short the call but you didn't have the stock, then you're going to be opened a short position in the stock. So when you get the assignment notice, you're going to become short the stock. And if you're short the stock, there is one little detail that you might not be aware of, which is that when you're short a stock and that stock pays a dividend, the one who's short has to pay out the dividend. It's going to have to come from your funds. So you're going to be losing money literally, because by being short the stock, you're going to have to pay out the dividend. So it's going to come out of your own money. And we don't want that, because the position we wanted was a short call, for example. So how to avoid this? When we identify that we have this situation, a deep in the money call, etc., the analysis that we did with the corresponding with the same strike put compared to the value of the dividend that's coming up, then what we need to do is we need to get that short call out of harm's way. How to do that? Well, there's many ways to do this, and we're going to look at some of them in the example when we analyze a situation in the trading platform. But basically what you would do is you would either close the position if that's what you want to do, and you feel that that according to your trading plan that's what this situation calls for, or you could simply stick with the same strike but roll it out in time, so give it more time, such that when you have more time to expiration, you're going to have a higher time value. By having a higher time value, your put is going to be higher as well, the corresponding put. So you're not going to be in a situation where the call holder is going to exercise his or her position and then you're going to get assigned. So you could close the position yourself. You could roll it out in time. You could adjust the strike, move it to a strike that's closer to at the money or even out of the money. And then by pushing up the value of the extrinsic value, then you're going to be able to be sufficiently sure that you're not going to be assigned. So when you're long calls, you should do this. And when you're short calls, you should try to avoid this, knowing that the other part, that the counterparty is going to be doing this. So we have a conclusion, and this is something that we're going to be analyzing when we look at the trading platform and we look at a real example. In the money calls are at risk of going through early assignment on the day prior to going ex-dividend when the price of the same strike put or the extrinsic value of that call is lower than the amount of the upcoming dividend. This makes short-term expirations especially at risk. The same analysis, but in reverse, applies to in-the-money call holders who, to maximize profits, should exercise buying the stock at the strike price, hedge with a put, and receive the dividend when faced with the same situation. So why is it important to do this analysis when we are on the day prior to going ex-dividend? The reason why we do this is because this is the point where the stock, in this case the in-the-money call, is going to have the least amount of extrinsic value, because you're the closest. You're at the point where you're the closest to the actual dividend payout. And also the other party, the counterparty, is going to exercise, and you take the least risk by doing this whole exercise on the day prior to the ex-dividend date, so you don't take additional risk. Now, let's take a look at the trading platform and see if we can look at an example and see this same information in action. So now we're going to take a look at the trading platform, and we're going to take a look at the stocks that are going to be paying out dividends tomorrow. So basically where the ex-dividend date is tomorrow. Today is April the 21st, and we're going to analyze, because we're using real market data, we're going to take a look at the ones that are paying out dividends tomorrow, April 22nd, and I've already pre-selected CVS Healthcare, and we're going to take a look at their options and see which ones might be at risk of assignment if we're short options, and which ones we should actually exercise if we're long options. So we got CVS Health Corporation, and this is a stock that pays out a dividend of 50 cents, trading currently at $60 and just about 48 cents. And we have the option chain here. And as you can see, we have weekly expirations and also the regular monthly expirations. And the ones that are going to be most at risk are going to be the ones that are the closest to expiration. So these ones with the least days to expirations are going to be the 3, the 10, the 17. And remember, we have to consider extrinsic value. So because extrinsic value depends on the time to expiration, the number of days. So that's why we're going to pick this one, and we're going to take a look at those expirations. So we're going to open up here the expiration with 3 days to go. And we have all the different strikes here. And the at the money is just around the 60.5. That's the at the money. So the ones that are at risk are going to be the calls. So these calls are trading with a certain portion of intrinsic value and extrinsic value because they're in the money. So we're going to focus on the extrinsic value. So the ones where the extrinsic value is less than the dividend that's coming up tomorrow are the ones that are going to be at risk of assignment. So if you have a short call that has a strike price where its extrinsic value is less than 50 cents in this case, that call is going to be at risk. Now, it doesn't mean that necessarily it's going to be assigned, although the ones that have, so the deeper in the money that they are, the more sure you are to be assigned. So these ones might be borderline assigned, but these ones are going to be for sure assigned. So if you have anything in this area, you're going to be assigned for sure. So there's two things that we're going to look at here. Number one, we're going to take a look at the extrinsic value of your call. So we can see that the extrinsic value peaks at the money, and then it starts going down as you go further and further out of the money or in the money. So you can see that because we have a 50 cent dividend coming up, you can see that the ones that are at risk would be strikes such as the 59, for example, has 37 cents, the 58.5 has 21 cents, and so on. So anything from this point and lower are going to be at risk. Now, remember, the extrinsic value is not the only consideration. We have to take a look at the value, which is going to be all extrinsic of the corresponding put, because these puts are out of the money. They're only made up of extrinsic value, and the ones where the value of the put, so the extrinsic value, which is all the value they have, is less than 50 cents, these ones are going to be the ones that for sure are going to be assigned. Why? Because if you, let's assume that you are the option holder. If you have a call that has an extrinsic value of less than 50 cents, it's a good thing for you. It would be a good thing for you to exercise because you're going to capture the dividend and you're not going to suffer through the price drop, or you will, but you're going to capture the dividend. So that's going to make up for it. And remember, when you exercise, the value that you're giving up is the extrinsic value of your option. Since this is very little, less than the upcoming dividend, you're okay giving that up. But also, if you really want to be technically hedged and protected, you have to not only convert your long option, your long call, to long stock by exercising, but you also have to protect yourself on the downside. Because what will happen if, for example, yes, you let's take a look at this one, for example. The 59 has 32 cents in extrinsic. So you can say, okay, I'm going to exercise because the extrinsic value that I'm going to give up is only 32 cents and I'm going to be getting 50 cents. Well, yeah, but what happens if you just convert it to stock, you pick up the dividend, you get it into your account, but then you don't know what's going to happen. What happens if by the time you open, it opens at $52? Then yes, you picked up the dividend, which you were not going to do if you had stayed with the call. But at the same time, you lost in the stock because you were not protected on the downside. Now, when you had the call, you can only lose the value that you have here. So, for example, you're only risking if we take a look at the 59, for example, you're only risking 172 to 189. This is the value that it currently has. This is the most you can lose. But once you convert to stock, you're completely exposed on the downside. So it can go from 59 down to 50, down to 30. There is nothing stopping. Yes, the stock is going to drop by the amount of the dividend, but that's the regular price movement is not affected by the dividend. So it might drop. You don't know. You don't know about that. Maybe they announce some bad results, or they give a warning about their upcoming results. We don't know about that. If you just convert the long call that you had, you're not only going to be giving up the extrinsic value of your option, the time value, but you're going to be converting it to stock, and then you're going to be risking everything all the way to zero. So if, let's say, you convert your long call to stock, and then the stock opens at 30, then you're going to be losing because you are going to be buying at 58.5, but you're going to be suffering through the stock drop. So you're going to be suffering a loss of $28 here. So it doesn't matter that you picked up 50 cents on the dividend, you're going to be exposed. So what you have to do is you have to hedge, and synthetically you have to recreate the position that you had before, so you're not exposed on the downside. So in order to do this, what you have to do is not only convert your long call to stock, but you also have to buy the corresponding put, so you're protected on the downside, and so that stock plus put is synthetically equivalent to a long call. So you're recreating what you had before, but you're picking up the dividend. So in order to do that, what you need to do is you need to make sure that the put that you're going to have to buy is less than the dividend that you're going to pick up. So let's say, for example, this 57. So if you convert the 57 to stock, your long the 57 call, you're converting the 57 to stock. At that point, you have the stock, you have to buy the put. So you pay 35 cents here. And now you have the same position. You used to have a call, the 57 call. Now you have the stock plus the put, which is equivalent, is synthetically the same position. So, but the difference is that you're going to pay 36 cents for the put, and now that you have the stock, you're going to be receiving the dividend, which is going to cover the put and have some profit on top of that. If you didn't do that and you had the long 57 call, what's going to happen is you're not going to get the dividend. Tomorrow the stock is going to drop, and the price of your stock, the price of the call, is going to be affected because the stock is going to drop by the amount of the dividend. So in conclusion here, what you can see is that any strike price that has a corresponding put that has a value of less than the dividend. So in this case, for example, the 57, 57 and a half even, 56 and a half, 56, 55, etc. All of these are going to be exercised, and if you are short the call, you're going to be assigned pretty much for sure. So you have to be careful here. And what I would do now, these ones could be assigned as well, the 59, 59 and a half, but that would mean actually not the 59 and a half because it has 57 cents, but the 59, 58 and a half, these ones have less extrinsic than the upcoming dividend, but anyone exercising this is going to have to bear the risk of it going down, so be exposed on the downside, because if they were to buy the put, they're going to be at a loss because now they're going to pay 81 cents to receive 50. So that might not be something that they might want to do. But the ones that are less than the ones where the corresponding put is less than the amount that we're analyzing for the dividend that's coming up, those ones are gonna be they're gonna be exercised and they're gonna be assigned if you're short, almost for sure. So as you can see, rule of thumb, just your in the money calls are going to be at risk. That's all the risk you have if you have short options. And you have to look at the corresponding put. If the put is less than the amount of the dividend, then those are going to be assigned. So what to do against this, what to do to protect yourself from this? Well, one of the things you can do is, for example, if you're short the 57 call, which is clearly at risk here because of the 39 cents here, 32.39. So if you're short the 57 call, one of the things you can do is just roll it out in time. If you're okay with your position, one of the things you can do is you can close it so that you don't have to, because remember, when you're assigned, you're going to be assigned a short position. So when you're if you're not covered, if you have calls that are short and you don't have the stock, if you have the stock, then you're going to lose it. It's going to be called away from you. So you're not going to get the dividend. But if you are not covering your short call with shares, then you're going to be short the stock. And if you're short the stock, you're going to have to pay out the dividend. So it's going to be something that's going to be going from you to the stockholder, to the new stockholder. So be careful here, because if you are assigned, not only are you going to go through a change in the makeup of your portfolio, but also you're going to have to pay out the dividend. So instead of having a short call, you're going to have short stock and you're going to have to pay out the dividend. So it's a pretty big change. So if you take a look here, now what can you do? Okay, so you can take the 57, for example, which has a corresponding put value of 32 to 39. So this one's at risk. You take that one, and if you really want to keep that position, you can always close it. But if you really want to keep that position, you can roll it. So you can buy this back. For example, in this case, let's do it. We're going to buy the 57 because you're short, right? So you're closing it, and you're going to reopen it somewhere else. So let's say instead of 3 days to go, now you go to 24 days to go. So now you're going to sell this one. So what you're going to be doing here is you're going to be buying back your 3 days to go, and you're going to be selling it again at a later expiration. And for that, you're going to get some credit. But more importantly than that, if you look at the 57, which is the same one, but in a later expiration, now you're talking about an extrinsic value that's quite juicy here. That's pretty big. So now the corresponding put is about $2. So here you're absolutely not at risk, and you're not going to be assigned. So this is how you avoid the problem of an impending dividend payout on short calls that are in the money and that are deep in the money and that have very little extrinsic value. So that's what I would do. I would if I feel that the positions run its course, or you're already sitting on some profits on it, you might want to close it. But if not, just roll it. Just get it out of harm's way and take the 3 days to expiration, convert it into 24 days to expiration, gain a lot of extrinsic value, and at that point you're going to be safe. Okay, So this is basically what it is. So just to summarize, so that you guys don't get lost. So to sum up, there's a dividend coming up for a stock where you have short calls on it and they are in the money and they're somewhat deep in the money, not close to at the money. What you have to do is the safest way would be to take a look at the corresponding value for the puts. And once you know the dividend that's coming up, take a look at the strikes for the puts, and anything that's less than the value of the dividend is going to be exercised and assigned to you pretty much for sure. So for example, this one, 50 cents. So my line would be just around here. These ones are going to be exercised and assigned to you for sure. And once they're assigned to you, you're going to have to pay out the dividend because you're going to be short the stock. Or if you had the long stock, you're going to lose it. So either way, you lose. Now, the ones where the extrinsic value is less than the upcoming dividend, but the put itself is expensive. So for example, the 59 is 35 cents of extrinsic, less than the 50 cents, but the 59 is going to be 74.88. So this is more than the dividend that's coming up. So those ones might be exercised, might not be exercised. Maybe some market maker already has some puts from some other time, or their book already has the negative deltas that they need, and they might exercise anyway. So these ones would be at risk as well. I would also be looking at pushing those out of the way. So pushing those out of harm's way. So I would also, if I have this one, I would also take that one and either close it or just roll it out to an expiration where the same strike, if you want to stay there, has a lot of extrinsic value and where the corresponding put is certainly higher than the dividend that's coming up. Now, this won't only happen for the front expiration. This can also happen for some other expirations, but of course, because the longer expiration that you're analyzing, the more time value those options are going to have. So the number of strikes that are going to be at risk are going to be less. So if we open up the 10 days, for example, here, 60.5. So which puts are at risk here? So which corresponding puts? So which ones would be here? So for example, this one, the mid is 43 cents, 46, 49. Okay, so just around the 54.5 and lower, those are the ones that are going to be at risk. So if you notice, it's not 57 anymore, it's 54. So the number of strikes that are at risk is less. And that's going to happen as you move further in time. So for example, this one, it's only this. So this is 17 days to go. So for this one, it's only the 45 strikes and lower. So by the time you hit 24 days, for example, it's only the 47.5 and lower. And if you go really far, like June, for example, in this case, 59 days to go, this is going to be only the 40 and lower. So it's only really a problem if you have either very deep in the money calls or if the expiration is very close. So your expiration is very close to the current day. So those are the ones that you have to be careful. Okay, so this is pretty much all there is to know about the dividends. So you have to act. So you have to constantly monitor your positions. Otherwise, you might be in trouble here. So just make sure you don't have deep in the money calls or any type of in the money call where it's an American style option, which is pretty much all of the stocks, all of the regular equity stocks are American, so they can be exercised anytime before expiration. Those are the ones that are risk, and especially the ones that have large dividends coming up. Now, be careful too, because usually, so for companies, they have dividends paid out quarterly, so every 3 months. But some ETFs, for example, I'm going to take a look at Diamonds, which is the Dow Jones. The frequency here is monthly. So you have to, if you start having in the money calls, you have to be careful here, because even though the dividend is really, really small, so it's only the very deep in the money calls that are going to be at risk, but it's every month. So you have to watch out for this, because like I said, if you have short calls and you don't have the shares, you're going to get short the stock, and either you might either have a capital problem where you're going to get a margin call, or you're going to be closed out by your broker, or you're going to have a position that you didn't want. So you were fine being short calls, but you don't want to have short stock, and especially you don't want to pay out the dividend. So this is basically the risk that exists with dividends. So everything that I just said applies to long call holders as well. So if you're the counterpart to what I just said, and you have you're long these calls, well, you're better off exercising and picking up the dividend, and then at the same time buying the put, so that you're protected on the downside. So because otherwise you might say, okay, yeah, I don't want the extra money, I'm fine with my position. Well, yes, but you're gonna lose money. So it's not really a matter of wanting to make some extra money, but it's a matter of not losing the money, because the day after, so tomorrow, CVS is going to open for trading at 50 cents lower than where it was going to open. So if it was going to open at 60.43, now it's going to open at 59.93, because the market is going to discount the dividend that was just paid out. So that's going to affect your long call, whether you want it or not. So just to avoid losing money, what you might want to do is just exercise it. This is the one time where it makes sense to exercise before expiration. You exercise, buy the put, pick up the dividend, and if you want the day after, if you're fine with it and you want to recreate what you had before, sell the put out and sell the stock out, and buy the call back. It's just the ex-dividend date that you have to be careful, so that you don't lose money on the dividend payout. Because remember, call and in general, option holders don't get dividends. Special or regular dividends, they don't get any kind of dividend. So I hope that this was clear, and I hope that you have a better understanding now of dividends. Like I said, the back of the envelope rule, just if you have in the money calls, so if you sell calls, if you have in the money calls, look at the corresponding put. If it's less than the dividend, then that one's at risk. Move it out of the way. Either close it, or move it to a different month, or move it to a different strike if that's what you want to do. For call holders, for call buyers, same thing. If the corresponding put is less than the upcoming dividend, exercise your call, get the stock, pick up the dividend the day after, and one day prior, buy the put, so that you're protected just in case there's a big drop on the next day. So I hope this was clear, and I hope to see you guys around next time. And thank you very much for your attention. Goodbye.